Good afternoon. My name is Jason Piper, Regional Director with MFS Investment Management, and we are here today to talk about the Introduction to Investing Student of the Market. Now, during today's session, we're not going to be able to take questions live, but if you do have questions that come up that we don't answer through the presentation, please email them to investmentservices@becu.org, and somebody will reach back out to you as soon as possible to talk to you about that. Thanks for being here with me. I really appreciate it. I'm excited to talk about the student of the market. There's a lot of things going on today. And what we really want to do is we want to talk about how do we put a process in place to help us not only take advantage of what we know about the market, but also protect us from some of our behaviors. And how can we work with an advisor to put these plans in place to help us reach the hopes, goals, and dreams we have for our money? So that's what we'll talk about. Before we launch into that, a quick disclosure. Hopefully you're able to read all of that as I move to the next slide. What I'd like to start with is I'd like to share with you the story of MFS. MFS has a fascinating history. We are the first mutual fund company. So MFS started the mutual fund in 1924. Now MFS stands for Massachusetts Financial Services. We are a Boston-based company. You will notice I do not have a Boston accent. I grew up here in the state of Washington and live here in Seattle today. Probably not too far from where many of you are. So MFS 1924. How did the first mutual fund get started? Well, to paint the picture for you, the average wage earner in the United States made $5 a day. Over 20% of the U.S. was self-sufficient farms, and if you wanted to buy a share of General Electric, it would cost you $232. So it was really difficult for the common average wage earner to be able to invest in the markets and the rapidly growing markets in the United States. So the mutual fund was started for a group of sea captains. The sea captains had a lot of money. They're gone for long periods of time. They wanted their money to be safe and well cared for while they were gone. And most importantly, they wanted to get it back when they came back. And so that's how the mutual fund got started. The original managers of the Massachusetts Investors Trust invested in 45 companies. And these are companies that you know the names of: General Electric, General Motors, AT&T. And when they did that, and by putting them into the fund, they actually revolutionized the way that people invest. So now, for the first time, anyone could invest in a fraction of 45 companies. So you had access to the markets. You had diversification. So instead of just buying one company, we had 45. You had professional research. We told our original investors, we won't invest in a company that we can't visit. And in 1924, that meant going out and visiting the factories, making sure these were legitimate, worthy investments from the ground up. Today, that's something we do on a global scale. And you had liquidity. You see, before the mutual fund, if you wanted to take, say, your shares of Eastman Kodak and you wanted to trade those in, you would actually have to have physical certificates, travel to an exchange, find a buyer. Physical money would come back to you. It's not like you just called the bank at BECU and had them send the money to your account. And oftentimes people didn't get all their money back because there was just too many hands touching it along the way. The mutual fund changed all of that. There's two important key points that I love to share about the first fund, and then we'll jump into the presentation. First off is that of those original companies we invested in, 45, 35 are still in business today. So I mentioned General Electric, General Motors, AT&T. One of the companies that I think is really interesting is a company called Illinois Central Railroad, which today is part of the Pepsi company. So it's really neat the way these companies have changed and grown over time. The other point is that we've never missed a dividend payment, not even through the Great Depression. And what that really points to is just investing and finding well-run, high-quality companies and owning them for long periods of time. And that's exactly what we're doing today, and that's exactly what we're going to talk about. So a couple of key topics that we will talk about. First off is, what are some of the common questions that come up when it comes to investing? There's lots of questions, and I would say, especially today, there's probably even more. But things such as, how much money do I need? Is it too late to start, or when should I start? What if I pick the wrong investments? Do I know enough to make important decisions on my own? One of the things I would think about as we go through this presentation is that when we make big life decisions, such as maybe buying a house, we tend to consult with a professional. We tend to have a real estate agent. We have a mortgage professional. We have people who help us and guide us and help us make really good decisions along the way. And there's lots of areas in our lives where we do that. Investing, planning for your future, planning for your retirement is no different. And luckily at BECU, there's a wonderful group of wealth advisors who can help answer these questions. The reason I'm not giving you an answer to these questions is because every single person has a different answer. So it's a very individual process. We'll talk about some of the high level things to think about and to remember about investing. But ultimately, it's a very personal process, and it's really nice, and it's best to have it personally tailored to you and to your own hopes, goals, dreams you have for your money. So let's talk about what can an advisor help you do. Well, there's a lot of things. You first off, we have to understand, why are we going to invest? What's our reason? What's our why? Everybody has a different answer for that. And then with our financial professional, we can discuss things such as, how do we invest to keep pace with or outpace inflation? That's a big question today. What mix of investments is the right mix for us that's going to not only solve the challenge of outpacing inflation, but also allow us to feel comfortable, to match our risk tolerance, where we can stay invested, we can stick to that plan without big emotional reactions, which I'll talk about. And then, how do we stay invested? You see, the key, we believe, is time in the market versus timing the market. Time in the market. You see, today, the average time horizon for retirement is 30 years. The average holding period for an investment, for investors who don't have an investment professional they're working with, is about 1 year. So the gap between those two things, we think, is one of the biggest challenges investors face. And working with a professional can really help bridge that gap and get them much closer to where you actually get the experience of what the market's doing. So let's talk about a couple of the key concepts about just investing, about compounding, about inflation. What are just some of the things that we need to keep in mind, and we need to just remember as we're considering investing, or we're even investing in the markets today? First off is the power of compounding. Okay, so compounding is what Albert Einstein called the eighth wonder of the world. He said, compound interest, those who understand it earn it, and those who don't pay it. And this is a perfect example of what is compound interest, and what does time compounding look like. So what we did here is we started with $1,000, and the rate of return is 3% up to 6%. And what does that look like over a 10, a 20, a 30, and a 40-year period? And you can see that over 10 years and even 20 years, the difference between 3% and 5% and 6% gets more dramatic as we move on. But take a look at the 30-year or the 40-year mark. You can really see that 6% number. It really starts to take off after about 20 years. And so that's compounding, and that's money earning money on top of money. And the longer that we can do that, the longer that we can have that process in place, the better our chances of getting the outcome that we want. The next concept that is definitely top of mind for many investors, for news stations, for the media today, is this whole concept of inflation. So what is inflation? Inflation is competition for goods and services. It means money chasing whether it's things such as gas, milk, even college educations. It's money that's competing for those goods and services. And the more money you have competing for the goods and services, for finite goods and services, the more inflation you get. So take a look at three examples that we put here that are from 1970 up until 2021. And I'm gonna caveat this by saying a lot has changed since here in 2022. So these numbers might not look quite right. But if you look at 1970, a gallon of gas costs 40 cents. The lowest number I can remember is 98 cents by the gas station by my parents' house. Well, today, or at least at the end of 2021, the national average was $3.41, but we here in the Northwest are definitely paying more than that today. So inflation has had a significant impact on gas prices, well over 750%. Take a look at a gallon of milk. 1932, or I'm sorry, 1970, a gallon of milk cost $1.32. And to me, that actually seems expensive in 1970. But you fast forward to today, $3.74, and they're definitely not factoring in things such as maybe organic milk or almond milk. So those cost a lot more than that. So conservatively, milk has an inflation rate of 184%. Take a look at the college tuition. This one to me is pretty mind blowing. 1970, you could pay for a public college, a year of public college for $350. Today, the national average is over 10,000, which is a 2,900% rate of inflation. So inflation is alive and well. And if you really think about what's the fundamental reason why we invest our money, the number one reason that we have to invest our money and not just leave it in cash or leave it sitting in the mattress is because we have to keep pace with inflation. If our $1 today buys, if let's say $5, because a gallon of gas costs about $5, if we use $5 on a gallon of gas, if we spend $5 on a gallon of gas, well, if that price of gas keeps going up, but our money's not growing with it, we're actually losing money. So we have to keep pace with inflation. Now, let's talk about how do we put a process in place that helps us take advantage of some of the things we know about the market, but also protect us from some of the emotions. You see, emotions are one of the biggest kind of challenges for investors. And that's because we know that over long periods of time, the market produces a return, and the S&P 500 has a return of about somewhere around 10% on average over many decades, 10% over a 10-year period. But we have these periods of time, even like what we might be in right now, where we have these really high emotional responses. And emotions are one of the reasons why the disconnect between time horizon and holding periods exists, is because today it's very easy to make reactions on, or to react to short-term news or short-term information that even though we may have a long time horizon. And we call that making decisions on long-term decisions on short-term information. So how do we put a process in place that prevents us from doing that or protects us from that? We call it allocate, diversify, rebalance. So what does each of those look like? First off, allocating. And what allocating means is it just means allocating to the markets. Okay, so it means allocating, in this example, we talk about stocks, we talk about bonds, we talk about cash. But what this shows you is why allocating and why we allocate to the markets, and why, most often investors seek out well-run, high-quality companies in the stock market, well-run, high-quality companies or governments or issuers in the bond market to grow their money. And that's because historically, it's been a pretty good way to outpace inflation. So if you take a look here on this chart, what you'll notice is that we have inflation at the bottom, consumer price index. And this has started in 1978 until the end of 2021. So the CPI, consumer price index, ran at about a 3.5% rate over that period of time, a little over 40 years. Well, one thing to keep in mind is for the last 10 years, we've had very low inflation. In fact, since 2008, up until really very recently, in the last, about 1 year, the average inflation rate was about 2%. So we had a period of very high inflation at the beginning of this time frame. We had a period of very low inflation at the end of this time frame. And what that means is you get an average that's about 3.47%, 3.5%. Now, look at cash. You have a very similar experience with cash. This says a little over a 4% average return in cash. But I think we all know that you'd be lucky to probably get 0.4% at the bank today. I'm not exactly sure where the rates are now. They might be getting much better, but 4% we haven't seen in quite some time. The reason is this. In the early 80s, interest rates were in the double digits. So that meant that if you put your money into a CD, you could make a double-digit return. But it also meant that if you borrowed money for, say, a house or a car, you were going to pay a double-digit interest rate on that as well. And as we've had this declining interest rate environment for about 40 years now, We've got to, again, back to around 2008 where interest rates reached a historic low, and they've stayed in that range since. So this number, I tell you that because this number I think is maybe a little skewed to a much higher interest rate environment, but cash paid you a little over 4%. Take a look at the bond market. So the bond market, bonds are just loans, and they're loans to companies, they're loans to governments, they're loans to potentially municipalities. And so over this period of time, the Bloomberg US Ag Bond Index, which is made up of treasuries, mortgages, and corporates, had a return of about 7%. So even outpaced inflation, outpaced the cash rate. And then finally, we get to the stock market, who is the very clear winner here. That dollar invested in 1978 is worth a little over $167 at the end of 2021. So now you can see where owning these different asset classes outside of just cash has been a great way to outpace inflation over time. The next concept is diversification. So I mentioned in the beginning that one of the things the first mutual fund did is that it allowed investors to diversify. It meant that they were able to invest in more than just one company or a couple of companies. They were able to spread their risk out, spread out their opportunity set. And that's exactly what diversification is today. The real simple way to say it is not putting all your eggs in one basket. Well, a fun little exercise that we can do here is just take a look at, we call it the jelly bean chart. But what the jelly bean chart really shows you is it shows you 10 years of history and data, and it shows you what asset class performed the best of that year, what performed the worst. And it just changes as you cross the page from left to right. So what I would ask you to do is this. In the year of 2012, so on the very left, pick your favorite color, whatever color it is. Just pick your favorite color and connect the dots visually on the page, and just connect the dots on that color and as you cross the page towards the right, and observe what you notice. And virtually every color that you pick is going to have kind of a wild ride, meaning sometimes it's high on the list, sometimes it's low on the list, but they tend to bounce around. I like to point out the red box, which is international. And you can see that international, sometimes it's in the middle, sometimes it's toward the bottom, sometimes it's towards the top, but it bounces all over the place relative to the other asset classes. The other one that does that quite a bit is cash, which is yellow. So we call that volatility. There's one box that didn't really have that same experience, and that is the diversified portfolio, which all it is just an equally weighted mix of all of the other colors. That's the very dark, it looks like a very dark gray, almost black box. And as you'll notice, it really just kind of follows the middle right down the page, never hits the top, never hits the bottom. And at the end of that time period, of the end of the 10-year time period there, you'll see the average return of the different categories. The diversified portfolio falls right in the middle. So we spread out our opportunity set, we spread out our risk, and we dampen the volatility, which volatility tends to be what causes these short-term reactions, behavioral reactions that cause investors to pull money out of the market, and then they don't experience the long-term growth of the market. Finally, let's talk about a concept called rebalancing. So rebalancing is the simple way to explain rebalancing is it's saying you're being forced to buy low to sell high without having to think twice about it. So one of the kind of idioms in investment management and investing is buy low, sell high. Easier said than done. Rebalancing forces you to do that, and it puts a process in place to do that. So how does that work? So in our example here on the left, you're going to see an original allocation that is 50% stock, 50% bond. This is in January 1st, 2012. Now let's say from 2012 until December 31st, 2021, you didn't do anything to that portfolio. You just let it run, didn't touch it. The market was going to do what it's going to do over that 10-year time period. Well, what ends up happening if you didn't do anything is that you become 78% stock and 22% bond. The challenge with that is that your risk profile has now changed significantly, meaning you're taking a lot more risk than you had originally signed up for. So that that may be okay, but for most investors, that's not really what they want. Well, rebalancing is simply going back in, whether it be once a year, whether it be once a quarter, whatever you determine is the best frequency for you and with your advisor, and resetting the clock, so to speak, back to what that original allocation was. So we started off with 50-50 in 2012, and then maybe the next year, regardless of time, really, but thinking about as long as our risk tolerance and time horizon didn't change significantly, we would set that back to 50-50. So we would be selling some of the stock and we'd be buying some of the bond. And then the next year, we would do the same thing. And what we have found is that as we do that over time, you actually end up selling the asset classes that get expensive and you buy the asset classes that become cheaper over time. And so, it may change. It may be that stocks become expensive. It may be that bonds become expensive. But as you put into place the process of rebalancing over time, what you find is that investors not only have less volatility, but they end up paying better prices for the investments that they're buying. Finally, let's talk just about a couple of the key points here. So, market performance, relative market performance of asset classes, it changes over time. That's exactly what we looked at on the jelly bean chart. The leadership of the market changes over time, and we're certainly seeing that in the big way right now. If stocks outperform bonds, your allocation to stocks grows. You're potentially taking more risk. When we measure risk, we do look at stocks as being more risky than bonds. Historically, that's been the case. And rebalancing forces us to get back in line with our risk profile. And as a byproduct, we sell the investments that become expensive, and we end up picking up the investments that have become inexpensive. Let's finally talk about staying cool, calm, and invested. And I want to come back to my comment on market timing versus time in the market versus timing the market. The market is not linear. So it doesn't just go up in a straight line. It doesn't go down in a straight line. And I think, what's with the volatility we're seeing today, I think that's kind of obvious at this point in time. But here's just puts this into a little bit of perspective. If you had $10,000 invested for 20 years in the S&P 500, so again, from 2012 to December 31st, 2021, if you were fully invested, didn't touch it, let it run, that $10,000 becomes $61,685. Let's say that you missed the 10 best days, 10 days in 20 years. That $10,000 becomes $28,000. So you have less than half. So half of the return over that 20-year time period came in 10 days. If you missed the 20 best days, your $10,000 is only $16,000. And if you missed the 30 best days, you might as well not have invested at all because you only have a little more than your original $10,000 in 20 years. So the reason that I share this is because time in the market is the key. And that means having a plan in place, working with someone who can help guide you into making decisions that are in line with your risk profile and your time horizon, and making sure that we're making decisions, long-term decisions on long-term information instead of on short-term information. I want to share a quick story, and then we'll wrap it up. So there was a company in the 1970s that developed the first digital camera. They spent a year building it, and when they were done, they had a camera that took pictures that weren't on paper, and they took it to the market, and nobody really wanted it. It wasn't popular at all. Another company came along a couple of years later, a company named Sony, developed the first digital camera for the consumer market. It took off, started the digital revolution. And if you think about digital cameras today, they are one of the key drivers of consumer technology. They're in nearly every device that we have as a camera today. That company in 1974 was a very popular and a very famous company. But when they shelved that idea, they said that nobody wants to see a picture that's not on film. That company was Kodak. And Kodak was able to last for another about 40 years as a company before they finally ended up going out of business. But that decision in the mid 70s is actually what ultimately led to them not going into the digital camera market and missing out on that huge opportunity. And so I tell you that story because investing works in a similar way. The great thing about investing is the outcome can be positive. And so we want to make sure that we're making decisions on long-term information and making decisions based on our time horizon, on our goals, on the hopes, goals, and dreams we have for our money. And ultimately, if we can do that, we have found in doing this for a really long time that investors have a better chance of getting the outcome that they want. So this is what working with an advisor can really help with. Understanding and putting down on paper what your goals are. What do you want out of your money? How do you want your money to work for you? Creating a plan that helps get you to reach those goals, and then guiding you to investments that will be a good fit for your risk tolerance, time horizon, hopes, goals, and dreams. And most importantly, keeping you on track. And that's easier to do when things are going really well. It's in times like this when it becomes really, really important. So I want to just let you know that there's a wonderful group of advisors at Boeing Credit Union that are ready to work with you, ready to talk about these things with you. If there's any questions, again, you can email them to investmentservices@becu.org. Someone will get back to you soon. And I thank you very much for your time today. I hope you have a wonderful rest of your presentations and the Investor Summit. Thank you.